Hello everyone, welcome to my latest video on Nism series 8 equity derivatives. In this video, I am going to take you through two key concepts related to payoff and profit in options. These two concepts of payoff and profit are very important for you to understand because you will be able to solve questions which are often asked related to these concepts in the exam. They will also help you solve numericals related to profit and payoff of the options contract. So let me explain these two concepts to you in brief. Payoff of an option describes to what extent an option has become in the money. In the money basically means to what extent an option has started generating the cash flow for the buyer of the option. You know that buyer of an option has the right but not the obligation to buy an option contract. So basically, when I have bought an option, depending upon whether it is profitable for me or not, I will exercise the right. So if I am a call option buyer, I will wait for the spot price to exceed the strike price. Okay, precisely what is mentioned here in the video. If you see this aspect, it very clearly says that the right is used only when the spot price exceeds the strike price for a call option. Now, the difference between spot price and the strike price defines payoff of a call option buyer. So payoff is nothing but the difference between the spot and the strike price, but we will understand it with the help of a formula as we proceed. In case of a put option, the payoff would be just opposite. It is calculated by finding the difference between strike and the spot price. So profit is arrived at the next step. Once you have arrived at the payoff, then you calculate the profit. And how do you calculate the profit? Profit is arrived by finding the difference between payoff and the premium. So till the time you are calculating payoff, you are not considering premium. The moment you calculate profit, you consider premium. So let me explain to you this concept with the help of a diagram. As you can see here, if it is a call option, if you are buying the call option, which is what we call as the long call, and it's very distinctly mentioned here. So in case of a long call, the payoff is max of spot price at a given time t minus x comma 0, which means that if the difference of the value becomes negative, then max of it would be 0 and 0 would be only considered. What does this mean? This means simply as a concept that for a buyer of the call option, payoff can never be negative. The minimum value of the payoff is going to be what we call as the 0. So 0 is what will be the payoff in the worst case scenario. That is why buyer of a call option never loses more than the premium, because the payoff can at worst be 0. It can never be negative. Similarly, when it comes to the long put, where you are buying the put option, the payoff is defined like this: max of s minus st comma 0. Now here x minus st means x is the strike price, st is the spot price at the given time. So if this value also becomes negative, then it will be considered to be just 0. So worst case scenario, both buyer of the call and buyer of the put, their payoff is going to be 0. But when it comes to the payoff of a short call, where you are seller of the call, the formula has changed. It is saying min of x minus st comma 0, which means for a seller of a call option, the payoff can also be negative, which means he will not just lose the money, he can lose money to any extent. His gain would be only restricted to the premium, and that is the same thing which is getting demonstrated here also in terms of min value. Can we put this formula in a different way? Yes, we can definitely put this formula in a different way also. Let me put in form of a grid and a structure. So if you want to arrive at the payoff and the profit, what do? You do is that you first take note of these four formulas. The first formula very clearly says that long call payoff is max of 0 comma s minus x. Here s is the spot price and x is the strike price. But when it comes to short call, we are using the value max of 0 comma s minus x with a minus value. So which essentially means that whatever is the solution that you get in Excel by using the function max, you will get a negative value, which means that the payoff can become negative, and that's why seller of a call can lose any amount of money. The same would go for long put and the short put. Now let us have a look at what do we do when it comes to calculation of gain and loss. So when it comes to calculation of gain and loss, we take into account the premium also, which was not considered here, but here we have considered the premium. Now this premium is adjusted in case of buyer as a deduction, which means you will write minus. So the same formula gets carried forward here. This formula itself has come here. And what you are doing is max of 0 comma s minus x minus the premium. But when it comes to the seller of the call, the premium gets a plus value. Why? Because premium is a receipt for seller of the call, while it's a payment for the buyer of the call. Okay. So that's how we distinguish what is called as payoff and the profit. Just to sum it up, payoff means is there a cash flow that is getting generated for the buyer? If it is not getting generated, then the value of the option is 0, which means he will lose the premium. And if the cash flow is getting generated, then that is deducted, that is taken into consideration, and the premium is deducted from that to arrive at the profit. So that's the concept of payoff and profit. I hope you could get some sense out of it. If you have liked this particular video, please do subscribe to my channel. You can write to me on healthofmywealth@gmail.com if you have any further questions, queries. Thanks for your time.